Humana's Q2 2026 earnings just dropped, and it is a massive mixed bag for investors. They absolutely beat on top-line revenue, pulling in a staggering $40.867 billion for the quarter, but the guidance is where things get completely wild.
Yeah, wild is definitely the word for it. I mean, they affirmed their adjusted EPS guidance at $9, but they took a giant red pen to their GAAP EPS, slashing it from over $8 all the way down to at least 6.52.
Right, so you're looking at this dense 20-page release and trying to figure out how a company grows revenue from roughly $32.3 billion a year ago to nearly $41 billion today, while simultaneously, gutting its own GAAP earnings projections. The market reaction was exactly the whiplash you'd expect.
Oh, for sure. It's a fascinating puzzle. Because if you're holding this stock or just trying to understand the business of aging in America,
Yeah.
this deep dive is your shortcut to figuring out what management is actually doing behind the scenes.
Exactly. So let's talk about the split guidance because it's just glaring. You've got this Q2 adjusted APS of 7.61, but the GAAP reality is just 5.73.
They are basically telling the market two very different stories right now. They want you to focus on that affirmed $9 adjusted figure for the full year and, look past the gap drop.
I always like to compare this GAAP versus adjusted split to selling a house.
Okay, I like that.
Yeah, so the adjusted price is the staging, right? It's
Right.
the fresh paint, the rented furniture. It's the ideal scenario you want the prospective buyers to focus on.
Right, the core day-to-day operations.
Exactly. But the GAAP reality forces you to disclose the cracked foundation, the leaky roof. And in this report, the leaky roof dragging down that GAAP number includes things like impairment charges and put-call valuation adjustments.
I'd actually take that house analogy a step further. It's not just the leaky roof, it's the fact that the entire neighborhood's property values might be fluctuating.
Oh, interesting.
Yeah, management is saying, hey, look at the staged living room, the adjusted operations.
Yeah.
Because GAAP forces them to drag all these non-operating financial maneuvers into the daylight.
Right.
Like, an impairment charge just means acknowledging an asset they bought in the past isn't worth what they paid for it. And those put-call adjustments, that's just highly complex accounting math on outside investments. It doesn't actually reflect how well they are selling health insurance today.
Okay, so they want us to look at the clean, staged house, the adjusted EPS of at least $9. But even there, management explicitly notes that this $9 figure anticipates a year-over-year decline.
Yeah, they do.
And the culprit they name is the, quote, bonus year 2026 star ratings headwind. Now, to an outsider, a star ratings headwind sounds like, I don't know, a bad Yelp review.
Right, like getting 3 stars on an app.
Yeah. But in the Medicare Advantage world, this isn't just about optics, is it?
Not at all. It is literally the foundation of their profitability. You have to understand how the government incentivizes these insurers. CMS, the Centers for Medicare and Medicaid Services, they rate these plans on a 1 to 5-star scale.
Based on things like clinical outcomes and customer service, right?
Exactly. And if your plan achieves 4 stars or above, you get a quality bonus. It's a massive amount of extra government funding.
Which they use to sweeten the deal for seniors.
Yep. They use that bonus money to offer $0 premiums or better dental coverage, which attracts more seniors. It's this powerful flywheel of growth.
But if you lose those stars...
As you drop below 4 stars, the bonus money vanishes completely. It's not a gentle slope, it's a sheer cliff. So when Humana cites this headwind, they are acknowledging the financial hit from a prior drop in the ratings. It's choking off their bonus funding for all of 2026.
Which perfectly explains the tension in this report. The government is giving them less bonus money, so they have to figure out how to make up the difference with sheer volume.
That's the play.
I mean, the insurance segment generated over $39.1 billion in Q2 revenue alone. But the metric that really shows the reality of this business is the benefit ratio.
Right, absolutely. The benefit ratio is the vital sign for any health insurer. It's just the percentage of premium dollars they actually spend on medical care.
Right, and Humana's Q2 benefit ratio came in at 91.2%, which is slightly up from 89.9% a year ago, but they stressed it's perfectly in line with their guidance of being slightly above 91.
And they locked in their full-year guidance at 92.75%, give or take 25 basis points.
Let's unpack what 91.2% actually means.
It means for every dollar Humana takes in, they are spending just over 91 cents paying doctors and hospitals.
Leaving less than 9 cents on the dollar to run the entire corporation.
Exactly. That has to cover marketing, tech, salaries, and any profit. It is a razor-thin margin to operate a $40 billion quarter on.
Which is why scale is so critical, and they're scaling fast. The data point that made my jaw drop was their individual Medicare Advantage membership. They're projecting 25% growth over 2025.
Yeah, achieving 25% growth in a mature market like Medicare Advantage is practically unheard of.
But wait, let me push back on this. If I'm running a software company and I increase my paying customers by 25%, my margins usually improve instantly because of economies of scale.
Right, normally they would.
But the report explicitly states this influx of new members is actually pushing the benefit ratio up, meaning these new customers are making them less profitable right now. Why is that?
Because healthcare economics are completely counterintuitive. In insurance, new members are incredibly expensive.
Walk us through that. They're bringing in new premiums, so what's the hidden cost?
Think about a typical senior just joining a new MA plan. Often, they haven't had their chronic conditions managed properly yet. They're bringing in what we call deferred care.
Like a knee replacement they've been putting off?
Exactly. Or they need new, expensive diagnostic tests. Historically, new members use a drastically higher volume of services in their first 12 to 18 months. It takes time for the insurer to enroll them in preventative care and stabilize their costs.
So a 25% surge in members is actually a massive influx of upfront medical claims.
Yep, and those claims drive the benefit ratio higher, squeezing the margins.
Okay, that makes total sense, and it perfectly explains this other confusing line. They mentioned their favorable prior period medical claims reserve development was notably lower.
Ah, yes, the reserve development.
Yeah, it was only $53 million in Q2 this year, compared to $161 million a year ago.
Right, so actuaries set aside pools of money to pay estimated claims. If actual claims come in lower than expected, that leftover money gets released back onto the balance sheet as a positive boost. That's a favorable development.
But because they have all these new expensive members, the claims are running hotter. They have less leftover money sitting in reserve because these new patients are actually using the insurance.
Exactly. So, look at the puzzle management is trying to solve.
Yeah.
You've got the star ratings headwind starving you of bonus revenue, and you have 25% more members driving up immediate medical costs. How do you survive that squeeze?
According to the report, it's ruthless corporate efficiency. They highlight that the insurance segment's operating cost ratio impressively dropped from 8.3% down to 7.1%.
Shaving over a full percentage point off corporate overhead when you're dealing with $40 billion in revenue. That is a massive save.
Yeah, it requires sweeping changes.
And they're pulling a few other levers, too. They're utilizing increased direct subsidies from the Inflation Reduction Act to buffer drug costs. And they negotiated better benchmark funding rates. But that administrative cost-cutting is the primary driver.
That you can only cut overhead so much, right? Eventually, you have to stop the expensive medical claims from happening in the first place. You can't just cross your fingers and hope your new seniors stay healthy.
Right. You have to actively control the actual delivery of their medical care.
Which brings us to Centerwell, their pharmacy, primary care, and home health segment. Revenue there grew to $6.79 billion in Q2.
And the crown jewel is senior primary care. It saw 27% year-to-date growth. They added over 130,000 patients, bringing the total to 622,000.
It's a profound shift in the business model.
Yeah, it's the payer-provider convergence. They are evolving from a company that merely pays the bills into one that employs the doctors.
I was trying to visualize this, and it's like a gym membership. For decades, traditional health insurance sold you the pass, but it was up to you to actually go to the gym.
And if you didn't go and had a heart attack, they just paid the massive hospital bill.
Exactly. But with Centerwell, Humana isn't just selling you the pass. They are buying the physical gym building, hiring the personal trainers, and literally standing next to your treadmill to make sure you do your cardio so you don't have a heart attack on their dime.
That is a perfect analogy. By acquiring physician groups and building their own clinics, they create a closed-loop system. If Humana's insurance arm pays for the care and Centerwell delivers it, they have total control.
They can mandate preventative care.
Right. They track if you're picking up your insulin. They intervene early to keep you out of the incredibly expensive ER. And if you stay out of the hospital, the insurance segment's benefit ratio improves.
It is a brilliant long-term play. But buying up all these physical clinics isn't cheap. The release notes that integration costs from recent acquisitions acted as slight headwinds.
Oh, the friction is immense.
Yeah, they specifically mentioned acquiring the Village's Health and a massive group called Max Health recently.
When you buy a group like Max Health, you aren't just flipping the sign on the door. You have to integrate complex electronic health records. You transition hundreds of staff onto your payroll, and you have to retrain doctors used to the old fee-for-service model to practice under Humana's preventative model.
That requires huge upfront capital.
It does.
But despite those headwinds, the CenterWell operating cost ratio still improved slightly to 92.4%. They are scaling this very efficiently. In fact, there's a direct quote from Humana's CEO, Jim Reckton, in the release that sums this up.
What did he say?
He said, quote, "When we get the clinical care right and run the business more efficiently, everything else follows: stronger earnings and better health and experiences for the people we serve."
That is the ultimate thesis of value-based care. Spend the money upfront on robust primary care, and you save exponential amounts on catastrophic care later. They're betting billions they can execute this better than independent doctors can.
Okay, so we've covered Medicare seniors and primary care. So expanding this level of control takes serious cash and new frontiers. Which brings us to state Medicaid contracts.
Right. Medicare's for seniors, but Medicaid is the program for low-income individuals, and Humana is making very aggressive moves here.
The standout detail is Illinois. Humana just won a statewide managed care contract there, going live in January 2027. And the crazy part, they were the only new entrant awarded a contract alongside 5 incumbents.
Breaking into a new statewide Medicaid contract as the sole disruptor is monumental. State governments are so risk-averse.
Right.
Humana had to prove to Illinois they have the financial stability and operational bandwidth to manage care for highly vulnerable people on day one.
Which begs the question, are they financially agile enough right now to pull off a statewide rollout while dealing with the Medicare squeeze?
Let's look at the balance sheet.
Yeah, their debt to capitalization decreased to 42.7%, which is healthy. They also entered into $1.5 billion of pre-capitalized trust security arrangements.
Basically a massive emergency credit line for contingent liquidity.
Right. But the metric that really caught my eye was the days in claims payable, or DCP. It dropped to 33.1 days. That's a decrease of 3.4 days from a year ago.
That is a critical metric.
Wait, if DCP is dropping, does that just mean they're rushing to pay doctors faster to keep them happy? Or is there a bigger cash flow story?
It's the cash flow story. It's a huge piece of the liquidity puzzle. DCP measures how long an insurer holds onto its cash before paying an approved medical claim.
Okay.
A dropping DCP means the company is flush with cash and aggressively clearing its liabilities off the books.
So if you run a local clinic, this means Humana is cutting your check over 3 days faster than last year.
Precisely. They aren't hoarding cash to float operations. And the report tells us exactly where a chunk of that cash came from. Their cash flows were boosted by the favorable timing of a $1.05 billion Medicaid state-directed payment.
Wow. Over $1 billion dropped into their accounts at the absolute perfect time.
Right. So look at the whole picture. Decreasing debt, a $1.5 billion trust, and clearing claims faster thanks to massive, perfectly timed state payments.
This war chest lets them confidently step into new territories like Illinois.
Exactly. They have the deep pockets to absorb those heavy startup costs.
So we have covered a vast amount of ground today. Let's pull it all together. Humana is a company of fascinating contradictions right now. They're driving massive top-line revenue, nearly $41 billion, but simultaneously absorbing the severe star rating shock that gutted their GAAP guidance.
And their solution isn't to play defense, it's to relentlessly grow their way out, taking on 25% more Medicare Advantage members, knowing it'll squeeze their benefit ratio in the short term.
Offsetting that by aggressively cutting corporate costs down to a 7.1% operating ratio.
While simultaneously pouring capital into acquiring primary care practices to build out CenterWell, transforming from a company that just pays for healthcare into one that actually delivers it.
And backing it all up with a highly liquid balance sheet to conquer new Medicaid markets.
For you, the listener, the key takeaway is that this isn't just a corporate scorecard. It's a real-time blueprint of how modern American healthcare is becoming deeply, irreversibly, vertically integrated. The boundaries between your insurance, your pharmacy, and your doctor are blurring.
Which leaves you with a final lingering thought to mull over. If Humana's CenterWell strategy is the future, and insurance companies continue to buy up primary care clinics and become the actual providers of healthcare, what happens to the independent neighborhood doctor?
It's a great question.
Are we rapidly approaching a future where your choice of health insurance brand dictates your entire medical reality? From the specific clinic you visit to the doctor you see, from cradle to grave?
It is a profound shift, and this earnings report proves the transition is already well underway.
It's definitely something to think about before your next checkup. Thanks for joining us on this deep dive, and make sure you follow this show for our daily earnings coverage. See you next time.